So hello and welcome to today's edition of LiveSquawk's Market Talk as we preview the impending FOMC interest rate decision later on today. To help me figure out what to look out for, I'm joined by two market-savvy experts. Firstly, a regular guest on Market Talk, Joseph Choi, author of popular market blog The Curve Advisor, and an active trader. And we're also joined by a special guest, Mark Zaccardi, publisher of freelance publisher and financial writer for financial advisors and investment companies. Very active on X. He has a background in macro investing, technical analysis, and energy trading. Welcome to you both.
Hey, thanks for having us on.
Always a pleasure, Joe. Always a pleasure. Right, just before we get into this then, and before I bring you guys in, a quick look at what we're looking at today. So at 1400 Eastern Daylight Time, 1800 GMT, we'll hear from the FOMC in their June interest rate decision. I've got a note here from Deutsche Bank economists. They anticipate the Fed will hold rates steady while mostly maintaining existing signals about policy. The statement, summary of economic projections, or the SEP, and Chair Jerome Powell's press conference will all likely indicate that the Fed can remain patient with adjusting policy. Updated projections for 2025 are likely to show weaker growth, higher inflation, and could show a softer labour market. Based upon these adjustments, the bank's baseline is that the median dot only shows one cut this year, albeit a close run thing. Beyond 2025, though, we expect only modest adjustments, says the bank, to the SEP, with the 2026 median Fed funds rate moving 25 basis points higher, in part supported by a small increase in the long run dot. Analysts predicted Powell's press conference was unlikely to provide strong guidance about the policy path ahead, and instead will emphasise elevated uncertainty. And with that, I'd like to bring in Mike. Mike, what are your first views or impressions about today's FOMC?
Yeah, so no move expected, and it's looking increasingly unlikely that we'll get a July cut. The Fed Fund futures market, just about a 15% chance that an ease on the July 30th decision date. So we'll probably be on hold here for a while, at least through Jackson Hole. So that's going to make that event all the more important as investors eye the September FOMC meeting for a resumption of the easing cycle. For today, it'll be interesting to see what adjustments are made in the statement about the health of the labor market. In previous updates and meetings from the Fed, they've been, fairly, realistic, but also upbeat on the health of the labor market. So, but we've seen changes in that. I think in the last couple of reports, we've seen a slowdown in hiring. The revisions to March and April payrolls within the May survey were particularly troubling. So we could very well be in a situation looking out a couple of months where if we see similar revisions, we could be looking at negative payroll growth like right now in the real time. So that's a concern. Today we got initial jobless claims, which were steady around 250. Those don't indicate recession, but continuing claims remain near the highest level since November of 2021. So clearly there's, it's not a stretch to say there's a freeze right now in the jobs market. Not a whole lot of hiring going on, not a whole lot of firing, but those who are losing their jobs are having a tough time finding new ones. So that kind of churn, that low rate of churn, we're seeing some repercussions in average hourly earnings, which have ticked down, which helps the inflation story. So to me, there's emerging risks on the growth side of the Fed's dual mandates. Inflation, is a risk from a tariff point of view, and you might say that higher oil prices could feed into that too. But to me, the risks are week by week tipping more towards the growth end of the spectrum. So the SEP is going to be interesting. So we'll get that summary of economic projections from the Fed that we get, each quarter, March, June, September, and December. This go around, we'll see if they do one or two cuts for the rest of the year.
I think the general feeling is that they may just scrape down to one from two this year, according to some of the bank research I've read. So it's going to be that you say it's going to be quite interesting to see where they go with that.
Yeah, I think it's going to be a close call there. In the near term, the September meeting it will be interesting to see if that's where the market pins it for the resumption. But then also looking out to next year, I mean, that's the thing, as we get toward mid-year 2025, more eyes shift towards 2026. So what the growth numbers and inflation assumptions through then look like are going to be interesting. And we'll get the SEP shortly after 2. But all ears will then be on how Powell reframes things, because he has a tendency of doing that when he gets to the podium. In recent press conferences, he's kind of leaned more towards the accommodative side, I think. So we'll see if there's any kind of difference there or added color that he might bring versus the SEP and statement. And then finally, on price action, it's important to point out that the stock market has historically not done well once Jay hits the microphone. So we'll see if we see a buck of the long-term trend from that perspective. And I guess one final point, the Fed members submitted their individual dots before a lot of the turmoil in the Middle East started. So they can always adjust those, but they probably didn't. So how Wall Street interprets the dots in light of what's gone on in just the last few trading sessions within the oil markets, that'll be kind of up for discussion too. So that just adds another point of uncertainty. There's that word.
That's a good point on the Fed board and their submission of the dot plot, really, because it's quite interesting there. And like we say, the uncertainty part is we haven't really seen energy markets affected drastically by what we've seen so far. Obviously, I think that's changing day by day, but we haven't seen that fundamental shift in the higher prices. So it's going to be interesting to see if, I think it was ratcheted up today with rhetoric we've had out of the president and both warring parties. But it's going to be interesting to see what happens there and how the Fed navigates around this level of uncertainty. Like you said, we've had uncertainty all year for the Fed, so they're used to it. But we're moving to another level, I would suggest. Joe, any views from your perspective?
Yeah, so I think the markets are going to be primarily focused on the dots. We had a lot of new information regarding Trump's tariff and trade policies since the March meeting. And so we'll get an indication of how the FOMC members are translating the new information into eases for this year and next. So with respect to the 2025 dot, in March, the Fed was only one voter away from having the median dot be 1 ease rather than 2 for this year.
Right.
And it's going to be another close call this time, since the economists seem basically split between 1 or 2 eases for this year. So since the March meeting, we learned that the tariffs are going to be larger and inflation expectations have been higher. However, we've also seen that both realized inflation and employment have come in a little weaker. So how the Fed translates this information into eases between this year and next year will be interesting. Also, the longer run dot could be interesting as a signal of how much the Fed thinks longer run inflation expectations and term premiums are anchoring, if at all. So I think most economists are expecting a stagflation lean to the Fed's economic projections. So going into this meeting, the markets have taken a flattening position in 2026 eases, playing for more eases next year.
Okay.
And and there's also been large new selling in the front SOFR futures, reducing some of the eases this year. Obviously not today, but earlier in the week. So this combination is probably due to the expectation of higher inflation projections combined with higher unemployment projections. So it's not clear to me how much of this pre-Fed positioning will be unwound on or if there's going to be a sell the news effect. And also, while I'm on that topic of markets, a market narrative I wanted to mention was the theory that the new Fed chair could be dovish. So as a result, more aggressive eases have been priced in for next year starting in June. And so I wrote a blog post about it this past week. And I think the key points are that the market narrative misses the Fed chair doesn't make decisions by himself. He needs to convince half the FOMC members to go along. And the new Fed chair may be looked upon as a shill and could get pushback. And this effect is exacerbated at a time when Fed independence has been challenged. So I think on a close vote, there are more likely to be voters who vote against the new chair than with the new chair. But I just wanted your listeners to be aware that there is this dynamic going on in the markets. And so you can't take, the current market pricing in a vacuum. You sort of have to figure in this additional factor.
Good point.
And then I guess with respect to Powell and the and his Q&A, I mean, he's always going to want to keep his optionality. So I don't know that he's going to say anything particularly revealing. The overwhelming market consensus is that he repeats the Fed's innovation waiting for the data narratives. And that's also my central scenario. But what I'm going to be listening for are some tone shifts and nuances related to the following. So on the bearish side, how strongly he's emphasizing inflation expectations. There was a Fed paper out a little over a month ago on the importance of inflation expectations. And I don't think it's a coincidence that we heard more FOMC members talk about inflation expectations this past month. And then on the inflation, very underwhelming. Core and super core CPI have averaged 0.16 and 0.06 respectively for the past 4 months. And thus far, we've actually had over half of the April 2nd full tariffs for about a month and a half now, and we haven't seen much of an effect. The prevailing narrative is that inflation will rise any month now from tariffs, and I don't disagree with that. But I think the thing that people need to have perspective of is that goods inflation, that which are affected by tariffs, is only a small percentage of CPI. And the bigger story is the declining services inflation and the weakening of the housing market. And we got some additional evidence of that today. That could effectually affect rents. And so, I think people need to just, put the tariff inflation in perspective. And then also on the bullish side, the Beige Book was weak. So here's a quote. Half the districts reported slight to moderate declines in activity. 3 districts reported no change. And 3 districts reported slight growth. And as you know, the Beige Book tends to, I think the Beige Book tends to shape Powell's presser narrative. So the Fed has 2 dueling mandates right now with higher risk of inflation and lower risk to growth. And so I'd be curious to see if Powell's assessment of the inflation risks versus the growth risks will have a slightly bullish lean. And, just from the rally today, I'm thinking maybe the markets might be leaning that way as well.
Well, just to add a little caveat on that for today's sort of action, we do have a holiday tomorrow in the US, so maybe, I don't know what the volumes have been like, but it might be interesting to see what the volumes are like. And obviously, ahead of an FOMC meeting, maybe some of the bigger paper stays out of the way and just waits to see what happens. But I just want to pick up on a couple of points you made there, Joe. The deflationary picture, well, I'm calling it deflationary picture. Do you see us, do you think, from a Fed's position, we're looking at the start of a deflationary cycle domestically? Again, like you say, leaving aside the goods issue, which is a smaller proportion of the overall economy and the makeup. Do you think that's something that's starting to be perceived by economists? I've not seen it a great deal, but I have seen the word deflation bandied about a little bit.
Well, I don't think. I mean, I'd be surprised if anyone on the Fed thought that we are looking at a deflationary cycle. I think the prevailing explanations related to the low inflation that we've had is that there might have been some overstocking issues ahead of the tariffs, and so maybe there's some product dumping going on. Like if you were a farmer, you probably couldn't sell a lot of your products abroad because of this tariff issue. And so, you're just dumping them on the local market. And companies may have been more willing to eat short-term price rises, but they may not be willing to eat the price rises going forward. So there could be more pass-through in future months. And certain things are a little strange. Like one of the reasons inflation's been low or lower car prices, but we've had these 25% auto tariffs for some time. So it's
Yeah.
not clear if that's from a signal of longer term weakness, or if there's something idiosyncratic in some of these markets that's causing inflation to be low. But I think the Fed is way more concerned about inflation being high than the prospect of inflation being low.
Yeah, but as I said, the latest sort of issues we've had around the Middle East could, have probably come a bit too late for, like you said, the dot plots initially. So it'd be interesting to see if anyone. We won't. I don't guess we know if they amend. If we'll get any kind of minutes that say they amended their initial dot plot, thinking maybe we get a Source's story or one of the board members will come out later in the week and say something. I just want to go over some of the points that some of these Fed officials have made in recent times. You've got comments here from the likes of, it goes back to May, but Jefferson, the voting governor, said that he has adjusted his growth forecast lower for this year, but still expects the economy to expand. He also said that tariffs are likely to interrupt the progress on disinflation. Jefferson thinks policy rates are moderately restrictive still at the moment, but says Fed does not need to hurry to make policy rate adjustments. We heard from Daly, who's a non-voter, but mentioned that the word of the day is patience. Goolsby's spoken over the last sort of 4 weeks and said it's important to remember that at the Fed, our job is to be the steady hand and not respond to the daily gyrations either of the stock market or policy announcements. Mike, just in terms of what you've heard so far and what you put on the table, anything in particular you're looking from Powell this evening?
Yeah, I'm most curious about any updates or changes in wording or tone on the labor market. Just as that unfolds, I think that may dictate Fed policy. I don't expect them to comment too much on what's happening in the commodity markets. And yeah, it'll be entertaining, I think, if there's and there's certainly going to be questions on the prospect of a shadow Fed chair. So that could provide some interesting sound bites, as Jay is wont to do. He's usually pretty good with impromptu nuggets for investors to kind of digest. So those are three areas that I'll be curious about.
Yeah, I mean, I will miss him when he does eventually step down, because I think he's been a surprise for me. I think he's been very even-handed, and again, I think a lot of central bankers missed the inflation picture, the hyperinflation we got after COVID. I think that was missed by global central bankers. But on the whole, I think he's been a steady hand for the Fed. I just want to go back to one of Joe's points as well. When you talk about the top 5 candidates for the next FOMC chair from Polymarket, they've got Hassett at 25%, and you bracketed him with Schill. Besant at 16%, although he has said he's happy at the Treasury and doesn't want to become Fed chair. But we all know in politics, a day's a long time. He's at 16%. Walsh, 19%, seen as a hawk. Shelton, which you put as a shill at 13%, and then Lutnick, he's getting a mention at 1%, also a shill. So I guess, like you said, the overloading of or the presumption that the next Fed chair, regardless of who it is, comes in and is immediately dovish because that's the want of the president. It damages the reputation of their independency for starters, and like you say, that may then get a pushback by some other members of the Fed because they work as a whole, not as a singular part. So I find that quite interesting. I want to move on to President Trump, and just briefly, and because it will take too long for us to go in the time we've got left to really go for everything. What are your views? And I'll start this time with Joe. What are your views on the situation at hand at the moment, and just from as a market player, as someone who trades on a daily basis potentially? I mean, where are you looking at the moment to trade, or are you not? Are you sitting on your hands? Are you just trying to wait this out and just wait for markets to calm down a bit, or wait for the rhetoric to calm down a bit?
Oh, well, so I primarily trade the interest rate markets. And to be honest, I know Israel, Iran has been in the headlines, and to a lesser extent, Ukraine and Russia. And the interest rate markets basically don't care that much. I mean, if you look at the front of the interest rate curve, it only moves a few basis points, if that, on any kind of news headline. So the bigger driver of the front of the yield curve is just going to be what is just going to be the prospect of Fed policy. But I do think Israel, Iran, for example, it does have some minor implications for the front end of the curve, or even the long end of the curve. And the first and the biggest impact is probably the impact of oil, and the impact of oil on inflation and inflation expectations. So since inflation's a major concern for the Fed, higher oil prices will increase the risk of stagflation. The Fed focuses on core inflation, but the higher oil prices will have reverberations into core and the rest of the economy. And then the two tangential things that I don't think the market thinks about that much, or thinks is a very low risk probability, is there's a very small increased tail risk of terrorism. So there are terrorist cells everywhere, but the thing is, I'm not sure the Iranians would want to anger Trump. So that's why I think, that hasn't really been much of a factor. And then the third is there's a microscopic chance of a wider war, especially involving another superpower. But I have a hard time seeing some realistic scenario for this as well. So
you put that as a low possibility, like the near non-existent possibility, would you?
Yeah, because I think at this point it's almost over. I just, even if this situation escalates, I'm not sure countries are going to jump in necessarily to help Iran. So and I don't think I'm alone in thinking this, because at least for the rates markets, I mean, it's not affecting rates whatsoever. I mean, I see that it's affecting oil. So if I were an oil trader, it would be like a big of a deal to me. But whether it's like rates or equities or a lot of the more traditional products, there just doesn't seem to be, there just hasn't been much of an impact. And I think the markets are putting the same probability on, those escalations as I am.
I think that's really interesting, just from a professional trader's point of view, for those listening in, just how you have to try and tune out a lot of the noise and a lot of the chatter that we get across, obviously because of social media, from the president himself. You have to tune a lot of that out and just look at the fundamentals, look at what's really happening out there. Mike, would you agree? Have you got a particular view on this?
Yeah, so I agree with that. I think that you look at the preponderance of historical data and these geopolitical events, they'll cause a little bit of near-term volatility, but normally they shake out fine for most markets. The only problem is, it seems like the consensus is so one-sided on that right now that this will blow over, and most of the big bank takes are fairly benign on the topic. Oil prices at $75 on WTI and close to that on Brent certainly are not overwhelming obstacles for the economy right now. And so, we saw oil prices lift off the April low, which was under 60 on WTI. Now we're, up 25% or so from those lows. But still, it's not overly dramatic. We would need certainly the situation to worsen, to spread out, more players get involved in the mix, for it to go significantly higher. I would call out, though, that we do see oil volatility, the oil volatility index, basically the VIX for oil, that is at the highest levels in more than 3 years. So that's the only, I wouldn't want to say alarming signal in the market today, but it's certainly something to pay attention to. We could still definitely see some fireworks in the energy markets if the OVX is any indicator. And I think we mentioned earlier, we have a U.S. holiday tomorrow, so it's going to make today's close a little more interesting. And July WTI futures, I believe, go off the board on Friday. So there could be some wonky price action in the next couple of days, and we'll see how the following month trades when we come into the desk on Monday.
Okay, interesting. We're going to start wrapping up now. I do want to leave though with some quotes from the president. This is via C-SPAN, and in terms of what he said if the Fed would cut rates by 100 or 250 basis points, then Treasury could term out the debt. Powell refuses to do it. He even suggests that he'd make himself the Fed chair. That's not that great for independency. But just some comments there, and the pressure, and that question will be asked again from Powell, and he'll bat it off again about his tenure and if he'll see out the course, which we know he says he will. So we'll take him at his word on that. Again, a bit more from Trump. We have no inflation. We have only success. I'd like to see interest rates get down. Now Biden did a lot of very short-term debt, so we have short-term debt coming due. And because of this guy's rates, if he'd lowered a point, I'd pay about a point less. Anything in Trump's comments, briefly, Mike, that you could hang your hat onto? And is he right about anything within what he said in the last, since he's come back to office, really, about the Fed?
Well, I think he's probably directionally right on what the Fed should do, but I wouldn't take
That's
what
as much
he's
as
saying.
you're giving him.
Well, his assertion that the Fed should be cutting rates is probably accurate given what we're seeing on the growth side of the ledger. Anything beyond that, though, investors should certainly look beyond and just take it as classic Trumpian comments and jawboning. So I would certainly not put any weight in comments like that.
Fair enough. And Joe, any last words from you on the president?
Oh, yeah. I think his comments are very short-sighted because if, say, the Fed were to ease 100 or 200 basis points in the next few months, I can almost guarantee that the long end yields would be higher than they are now. And so I don't know to what extent, because the markets will take that as a sign that the Fed's not serious about inflation. And so you can only take these large eases when the markets are convinced that the Fed is going to keep inflation contained. If the markets think that the Fed doesn't care about inflation, the long end could really sell off and crush the economy. So I just think of it as a very short-sighted opinion. I think it's more political than serious, because I think Besant probably would have told him that you can't ease 100 points and expect the long end to come down in yield. I think what could be interesting is if the new Fed chair were to engage in yield curve control or try to get other members of the FOMC on board on that. But that's like a story for another day. Yeah, but the way the interest rate markets work, if they eased a lot now, that's going to have terrible a terrible impact on the longer end. And we actually saw this last fall when the Fed eased 100 basis points and the long end sold off. So we could see a much worse version of that.
Okay, interesting. Just a quick note, Jackson Hole, which we mentioned at the top of the program, this year will be held August 21st through to 23rd. And the subject matter or the theme of this year's one is labour markets in transition, demographics, productivity, and macroeconomic policy. So for those interested in when Jackson Hole is, which is probably when we'll see a reveal from the Fed chair really as to, and traditionally I think that's been the case. They tend to drop a couple of hints at Jackson Hole as to their thinking and potential rate path moving forwards. Anyway, guys, listen, our time's up, and I'd like to thank you both very much for your participation in today's episode. Anyone who wants to listen to this, you can listen back on Apple, Amazon, and all the other platforms, the blog platforms, podcast platforms rather, and also you can just look us up on X and on the likes of Facebook and listen back to it in its entirety. Joseph Choi, thank you very much, the Curve Advisor.
Oh, thanks for having me on.
No, always a pleasure. Mike, thank you very much. Mike Siccardi.
Thank you.
Brilliant. Thank you very much. Mike, freelance financial writer for financial advisors and investment companies. He's active on X. You can look at who we follow and you'll see that we follow Mike. So please have a look at what his content as well. Thank you both. The announcement, as I said, is at 1800 GMT, 1400 Eastern time. We're covering it here at LiveSquawk. So if you don't know who we are, come and take a trial of the service at livesquawk.com and see if it will help your trading day. Thank you both again. And everyone else, good luck trading tonight's event if you do. Thank you very much.